Welcome. So I'm just going to test some audio just real quick and make sure that I sound okay. I think I sound pretty good, right? Let me know in the live chat if I don't sound good at all. I should, but really appreciate you guys being here. Big news today. So welcome to another public live stream session. And man, am I super fired up to talk about the Federal Reserve's decision today to either cut interest rates or keep the interest rates steady at 5.25 to 5.5%. And most of us are already predicting that rates will remain the same at this FOMC meeting. But why should you care about this? Because besides the interest rate decision, the Fed is going to release the summary of economic projections, and it will somewhat tell us and Wall Street what the Fed is thinking our economy will do for the rest of 2024 as far as unemployment goes. As far as unemployment goes, and as well as PC inflation, GDP projection, and how many times the Fed is going to cut interest rates for the remainder of 2024, 2025, and 2026. And you know something else that's going on in 2024, and that's the election season. And the Federal Reserve is in charge of the monetary policy, while Congress and the executive branch are in charge of the fiscal policy. And what the Fed does will have a direct impact on our economy, but the American people will vote for the candidates based on the current and upcoming economic conditions. And that's why Congress and the White House are both stressed out about the Fed, because despite what Jerome Powell says about how he stays out of politics, what the Fed decides to do today and going forward will have everything to do with this year's election season. And if you're watching this on replay, I will be sure to leave the timestamps in the description below so you can navigate the Q&As and other source materials I'm going to show you in this video. But in about 30 minutes, the Fed is going to announce its decision to maintain its interest rates at 5.25 to 5.5%, or are they going to surprise us with a rate cut? Highly unlikely. You have to remember that the Fed cutting interest rates is not necessarily a good thing. And it could mean that there's some economic weakness or headwind coming up in 2024 that we're not even aware of. But our economy in general right now is still growing and not showing any slowdowns. And at the same time, they're going to release the summary of economic projections that only comes out in March, June, September, and December every year. And this document will give us the dots for every Fed governor's position on the interest rates. And keep in mind that Jerome Powell is the chairman of the Federal Reserve, but he is not the only person making the decision to raise or cut interest rates. This document will tell us Fed officials' projections for the central bank's short-term interest rates. This is going to make an impact on your high-yield savings account, CDs, mortgage rates, and even the stock market. And I'm not gonna, I am gonna give you the full breakdown as soon as it comes out in about 30 minutes. And then in less than an hour at 11:30 a.m. Pacific Standard Time, I'm gonna live stream Jerome Powell's press conference and the Q&As he's gonna get from the reporters. And trust me when I say his words matter. They really matter. And that press conference should last about an hour, but I'm going to go over the Q&As throughout the live stream. So feel free to put them in the live chat. Let me know in the live chat where you're watching this from. And while you're watching this live stream, you can download my retirement calculator and other financial tools for absolutely free by visiting firesightshare.com/resources. And if you're interested in joining my private client program to get financial coaching and financial planning services, you can schedule a free consultation with me by visiting firesightshare.com/coaching. And stay tuned because I'm going to give out 5 free membership, channel membership in the middle of the live stream. And my membership will give you early access to the videos that are not published to the public audience just yet. And I will reply to the comments you put in the videos. So stay tuned if you want to be one of the lucky ones to become my channel member. And you can always follow me on Instagram if you want to know what's going on behind the scenes and stay up to date on my content. Let me pull up the CME Fed Watch tool here. I don't really look past July or September because those are just way too far out. And we have a Fed meeting today, and then the next one is in May, then another one in June. And I highly doubt that they're going to cut interest rates at all today or even the next one. If you watch my live stream last week about inflation, the CPI release, the inflation report came in way hotter than expected. And the job growth is still strong overall in the US. And we have 6 Fed meetings remaining in 2024. So there's always a chance that the Fed won't cut interest rates at all until 2025. And I would be very shocked if the Fed decided to do that. And Congress, from both sides of the aisle, is pressuring Jerome Powell on the monetary policy, and Democrats on one side want the Fed to cut the rates as soon as possible without meeting the 2% inflation rate, while most Republicans on the other side would like the Fed to take it slow. Now, what Congress really cares about is the election season that's coming up in November. Who's going to take control of the House and who's going to take control of the Senate? And before you get all crazy in the comment section, I will always keep this channel apolitical. And I never say where I stand politically, but I will always support or oppose policies that will directly impact our personal finances. This is a personal finance channel after all. But anyway, during the Q&A between congressional members and Jerome Powell, the Democrats were actually more confrontational with Jerome Powell by pressuring him to cut interest rates. They questioned him mainly on the 2% Fed mandate and that interest rates are way too high for the American people to buy their first homes. The latest CPI showed a 3.2% year over year increase, and the PCE inflation was at 2.8%. And Powell's argument is that we're not there yet and that he doesn't want inflation to flare up again if the Fed cuts interest rates way too soon. It is interesting, though, that he is getting pressured by the Democrats because he is technically an appointee under the Biden administration, but he was originally appointed under the Trump administration. Jerome Powell is technically a Republican, and Trump and the Republicans are saying that the Fed is actually helping the Republicans secure their elections in the coming year by keeping the interest rates high. And let me know your thoughts on that in the comment section down below. And again, if the Fed cuts interest rates because of spiking unemployment and dropping in GDP, then that's not a good thing. That means we got a tough time ahead with a possible recession. But it would make sense for the Fed to slowly cut interest rates when they see the inflation rate reaching probably between 2 and 2.5% with a healthy unemployment rate and job growth. And if I were a Fed governor, I would probably just cut the rates by 25 basis points, one meeting at a time. And if I had to take a wild guess, I don't see the Fed cutting interest rates until probably the June FOMC meeting here. Okay. Oh, let me go ahead and refresh that again. All right. They'll probably start cutting rates in June by 25 basis points, maybe another 25 basis points in July. But I have a feeling that they're going to keep the rates where they are if the job growth is still there. And if they cut 3 times in 2024 by 25 basis points in each meeting, then the Fed funds rate could potentially go from 5.25 to 5.5 to 4.5 to 4.75% by the end of the year. Some economists believe that they will cut the rates to as low as 4.25 to 4.5% by 100 basis points from now. And I think that's probably the lowest they'll cut, but very unlikely. They might even surprise us with just 75 basis points. And I want to quickly talk about this. While the US economy continues to grow, inflation is still very high in certain sectors. In some markets, the rent and home prices are still unaffordable to the middle class. Car insurance and homeowners insurance continue to rise in many areas. The childcare costs, like this article says, are so much more expensive than from the pre-pandemic level. My daughter was in daycare, childcare, when she was between 1 and 4 years old until she went to kindergarten. And I remember how expensive it was for me at the time as a single father. But it wasn't as expensive as it is now, which has tripled the cost from 2018. And this is one of the contributing factors to the declining birth rate. And the declining birth rate is actually not a good thing for our future economy. And according to the Bank of America survey, the average US couples with 2 kids spends over 30% of their income on childcare. This is absolutely insane because childcare costs are so high. Many women are leaving the workforce uh, to become stay-at-home mothers. And people like single parents or dual income parents who don't have a choice but to enroll in the childcare program are financially suffering, which prevents them from saving money or investing in their retirement. Childcare in the US has become so expensive because of how many staff members are required to be present for the number of toddlers or infants at a time. The labor cost has also gone up, right? So those childcare employers have to pay the staff more money on payroll. And when I dig a little deeper into this issue, these childcare employers are barely making it because they're not making as much profit like they used to. They have to pay a higher insurance fee for the daycare center because of the risk of having smaller children. And it's much more expensive to maintain their facilities, purchase supplies, and acquire equipment. And many experts believe that the federal government needs to pour more money into the childcare system. So let me draw something here. And I want to show you this because this is actually very, very important that a lot of people actually don't realize what's happening. Okay. Draw some stick figures. Okay. So let's say the government doesn't step in at all and we continue to have a declining birth rate. Okay. So this is, oops, this is me and I'm working, right? And it's not, and let's say there's a retiree. Terrible handwriting. I know. Don't judge me. Okay. But it's not a good thing to have an aging population, which is what's been happening in countries like Japan and South Korea. The government will have reduced tax revenue from people leaving the workforce to stay home with their kids. And there are many baby boomers who rely on the Social Security program to pay for their bills. But if we have a uh, decline in workers, Social Security could eventually completely become financially insolvent because they don't have enough payroll taxes coming in. The government knows this, but nobody has really paid attention to the declining birth rate until about the last 20 years. And as of 2024, we still don't have enough workers to fill all the jobs. In 1950, the worker to retiree ratio was 16 to 1, right? That was right after World War II. In 1960, it was 5 to 1. Okay. And right now, we're about 2.9 to 1 retiree. And by 2025, this is going to go to about 2 to 1. Okay. So it's going to be about 2 to 1 worker to retiree ratio. Not to mention that retirees are surviving a lot longer than the previous generations, right? So every time I am working, half of my dollar goes into the retiree, and the other half goes into disability. Okay. There's Social Security disability. So every dollar I contribute to Social Security fund, it's not coming back to me. It's actually going to the retirees or Social Security disability fund. Okay. So that's how it works. It's weird. I get it. All right. So the declining birth rate and higher cost of childcare are probably two of the largest, not the largest, but two of the contributing factors to our overall economic condition. And there are so many other things that I haven't touched on, but here are some potential solutions for these problems. First, both the state and federal governments need to step in and to start investing in childcare programs to reduce the costs. But is that going to encourage people to have more kids? Probably not right away, right? Second, they could relax some of the regulations to require how many staff members are in every childcare center, but there's a safety of risking, no, there's a safety risk of doing that, right? Or third, they could start incentivizing families to have kids like some of the European countries do. But we're not a small country like those European countries. Our government is not structured that way. It's going to have to be state dependent, more likely, instead of relying on the federal government. You could even ask your employer to work from home for 1 or 2 days a week, if you really need to save money on it, to reduce your childcare costs. If they don't allow remote work, ask your employer if they offer any type of childcare assistance. And if your employer offers what's called a dependent care FSA or a flexible spending account, you could pay for your childcare expenses in pre-tax dollars instead of after-tax dollars. And I've been using the dependent care FSA for a while, and it's saving me about 24% by doing that. And I have a video about that on my channel, so be sure to subscribe if you haven't done it already. And you can also schedule your first session with me by visiting firesidechat.com/coaching to talk about your current financial situation. And this is why we're seeing many companies developing AI products and services so that they don't need as many humans to do the work. But there's also going to lead to a smaller labor force. We're not seeing that right now, but we will, which is why many politicians are talking about universal basic income. And I think that's a little premature, right? And I think the UBI concept will become a much bigger reality once artificial intelligence is fully integrated into our society. But at the moment, right now, if Congress doesn't do anything about the Social Security program, whether you like it or not, there's going to be a crisis for future retirees. And wage growth continues to be one of the contributing factors to the current inflation rate. And there's no doubt about that. Even if the government starts handing out money to have more kids, it's going to take some time to get back to the level we once were. And this is why many millennials and the younger generations are not relying on Social Security to exist when they retire. I'm not. And I know this is a controversial topic, but I'd love to know your thoughts in the live chat or in the comment section if you're watching this on replay. Cool. Nice. Awesome. Hello from New York. Well, I should say hello from Vegas. Thank you. Awesome. I'm still tweaking it. I'll talk about that in a little bit, but well, later on. But 401k calculator, that one, it's pretty spot on. So if you haven't downloaded that, go to firesidechat.com/resources, and there's you sign up for the level 1 membership. It's free, no credit cards, none. You just sign up for your email, name. It's free, right? And then when you go into the dashboard, you can download that 401k calculator. And if you're a TSP investor, there's a TSP price tracker on that dashboard as well. So you're going to see the TSP prices get updated on a daily basis. And it's even going to show you how the fund performances are doing for CSI and G and F funds. So you can take a look at those and how they're doing since the beginning of 2024. So take a look at it. I appreciate that. Let's see. Hello from Virginia. Hello from Oregon. Awesome. You're welcome. Yeah. Did I gift you? You know what? I haven't. Have I? You know, let me go and do that gifting real quick because I love you guys. You guys are so great. Let me take a look here. Click on this. Click on this. Gift now. Cool. It's like a random gifting by YouTube. So I think it's 5, is it? Let me double check. I haven't really messed with that. Or is it 3? I'm not sure. It could be just 3. Sorry. I thought that was 5, but I guess it's just 3 now. Weird. All right. Cool. If you have any questions, just go ahead and put them in the live chat. And this is being live streamed to Facebook and Instagram. So shout out to you guys on Instagram for watching this. So I'm going to be taking some of the questions that you guys are asking. Let's take a look here. And we still got about 10 minutes until the Federal Reserve makes their decision. So I'm going to close that out. Okay, first question. Let's see. I just started a new job and my employer uses a 401k plan with Vanguard. Awesome. And there's an option for traditional Roth and after-tax contributions. Yep, that's right. And can you explain what an after-tax contribution is? Yeah, so most of you guys with a 401k, only 27% of the 401k plan actually comes with after-tax contribution. Most of you will see traditional. Well, all of you will see traditional. And most of you will see Roth 401k, and then there's the after-tax contribution. So this is actually a really good one. Let me go and because I was teaching my client on how to do that a while ago, and pull up the slide here that I taught this. Yeah. You know what? Mega Backdoor Roth. I'm gonna go ahead and show that real quick. But when you're doing the 401k after-tax contribution, be very careful because you need to track your source balances between Roth and after tax. After tax is in a completely separate pocket of money. Okay, it's aside from Roth. So when you have a Roth 401k, you know how Roth 401k just grows tax free, right? After tax contribution, it does not grow tax free. It is tax deferred. So when you're retired, you'll have to pay taxes on the after tax contribution inside your 401k. But there's a trick of doing that. And I'm going to show you this real quick. Let me nerd out for the next 2 minutes here. So 401k, great. This is updated with the latest numbers. This year's total contribution, I know you're hearing 23,000, all that. That's the employee contribution limit. But the total 401k contribution limit is actually $69,000. So some of you guys may be in a very high paying job, salary, making, let's say, $300,000 a year, and the employer contributes like 3%, 4%, or 5%. They can easily max out the employee contribution and get to $69,000. I have seen it. Okay. Not very many people get that, and that's okay. But I'm going to explain this because some people do have this after tax contribution. So there you go. Employee contribution is $23,000. And if you're over the age of 50, it's $30,500. So you have an extra $7,500. And that can go as an employee, you can put money into Roth or traditional, right? And then as an employer and as an employee, this chart doesn't show the employee portion. You know what? Let's talk about employer real quick. As an employer, with the Secure Act 2.0, you can actually contribute to the Roth 401k as well, but you have to be the one paying taxes on it. Okay, so if you get an employer match, 90% of you right now is putting that money into traditional 401k here. Okay, and then or if you elect to do Roth 401k, you can do that too, Roth 401k. Now, there's the after-tax contribution. So after-tax contribution would be the third bucket. I used to have Vanguard 401k, and I remember I used to do that. Okay, so there are two ways of doing it. One way, if you don't have a Roth IRA with Vanguard, that's what I did to make it easy to do what's called in-service withdrawals to Roth IRA. I'm going to explain that in a little bit. But if you do the in-plan rollovers to Roth 401k, so this money, whatever you put in, let's say you put $40,000 into the after-tax contribution because you make really good money, you could roll that right into the Roth 401k, but you have to segregate the costs, right? So you have to segregate what you put in as Roth 401k. You have to segregate what you put in for after-tax contribution because, again, you have to pay taxes on the earnings and interest that accrue from after-tax contribution. Roth 401k, you do not pay any taxes on the earnings or interest on it when you're retired. When you're retired, again, you'll have to pay taxes on the earnings and interest for the after-tax contribution. Make sense so far? Okay. Now, I did this route, and you want to ask Vanguard if they still do it. I'm pretty sure they still do. Okay. What I did was I opened up another Roth IRA with Vanguard. So every time I put in, let's say 40 grand this year for after-tax contribution, I'm just going to go ahead and write that down. You know what? Let me go and change the color. Okay, so I put 40K into after-tax contribution. Now, going into the Roth IRA, so every time I put money in there, it just automatically goes into my Roth IRA with Vanguard. So why is that important? Because Roth IRA is structured as no taxes on the earnings and interest, right? So all the dollars that accrue inside the Roth IRA, you don't get taxed on it. So I don't want to pay taxes on the growth or interest by putting money into the in-plan rollovers to the Roth 401k, right? I wanted to put money into Roth IRA to grow tax-free and not penalty-free. It will be tax-free for earnings and interest inside my Roth IRA. So when I turn 59 and a half, I can take that money out from my Roth IRA, tax-free, penalty-free. So you could essentially put $40,000 a year into the Roth IRA as a in-service rollover. In-service withdrawal, and you don't get penalized for it, and you don't get penalized, or you don't get taxed for doing that. Okay, and it also doesn't count towards your contribution. It doesn't. Okay, so you have to be very careful about this though. Get a spreadsheet if you can, and just keep track of how much money you put into the after-tax dollars. Okay, and once you want to keep track of how much is going into the traditional, how much is going into the Roth, and how much is going to the after-tax. And if you get to do this automatically every single month or every single time you get paid, this is going to be really easy for you. All right. Not at first. It'll take you a couple months. Really good question. It's so awesome that you get it. Not very many people get it. Just be careful. One more thing I want you to be very careful of. Okay. If you get an employer match, remember, if you put too much money into the after-tax contribution and you already maxed out at $69,000, you're going to lose out on the employer match. Okay. So that's why you have to kind of under contribute just a little bit if you have a pay increase coming up. And so you have to kind of manually calculate how much money it's going into, let's say, Roth 401k, and then you get a employer match going into traditional 401k. And then whatever money you have left, you want to put into the after-tax contribution. You have to make sure this after-tax contribution is less than your employer contribution or employer match. Okay. Because you don't want to put all of your money into the after-tax contribution and then you end up missing out on the employer match. That is the last thing I want you to do. But really great question. Good luck to you. I used to do this. It was great when I did it. 2017, I contributed $54,000. I did a video on that last year. 2018 was like 55,000, and then 2019 was 56,000. So it was a really, really great after-tax contribution to catch up on my retirement. So if you're looking to catch up on your retirement, ask about after-tax contribution with your employer. Okay, so let me share this real quick because we have stuff going on, like the Federal Reserve making their decisions. So I'm going to go ahead and share Bloomberg. Okay. Don't want to be late on this. Make sure you guys can hear it.
This decision. Let's check out the scores. If you are just joining us, we're about a minute away from the Fed decision. The scores look like this going into it. Equities very close to all-time highs,
Let's see what happens.
Just a touch. Bramo, we're down about 0.1% on the S&P. We're very, very close to all-time highs. This is not where we thought we would be. To Mohammed's point, at the start of the year, we had March penciled in. Many houses did, looking for a rate cut in March and anticipating that if we pulled out those cuts for this year, down from 6 towards the Federal Reserve, who were at 3, then this equity market would sell off. This stock market has not sold off.
We've been talking about Jensen versus Jay, and that's sort of where we're at right now. The NVIDIA AI craze versus Jay Powell trying to put the brakes on an economy that seems to have more gas left.
Should be happening in about 10 seconds.
It doesn't surprise me that
take a look here.
Little movement in stocks or bonds right now, because why would anyone try to front run this given the proclivity to maybe a little bit more volatility post news conference?
Well, let's turn to the bond market and we'll talk about where we've been before today. Yields have been climbing higher over the last week or so. Fixed income, treasuries, 2-year, 10-year, 30-year look like this. We're down about 2 basis points on a 2-year, 466.61. On a 10-year yield, we're down about a basis point or so. 430, very close to the highs of the year on a US 10-year. Right now, 427.68, and very close to 470 on a 2-year. With your Federal Reserve decision this afternoon, we can cross to DC with Mike McKee.
Here we go.
The Fed sees higher growth, stronger inflation, and slightly lower unemployment for 2024, but officials still barely see a median of 3 rate cuts for 2024. 9 of the 19 members, however, said they thought 2 or fewer rate cuts would be appropriate. 10 saw 3 or more. They did not change rates today. The dots move a little bit next year. The median sees 2 cuts to 3.9% in 2025 instead of 3 cuts, 3 more to 3.1% in 2026, a slightly shallower path. The committee's median long run, the natural rate, also moves up to 2.6%. GDP is projected to increase 2.1% this year, a significant upgrade from the 1.4% in the December forecast. Growth is also higher in 2025 and 2026. Unemployment will end this year at 4%, Fed officials now say, instead of 4.1%. And core PCE inflation will fall, but only to 2.6% instead of the 2.4% seen in December. Headline inflation unchanged at 2.4%. The only change to the statement is job growth is no longer characterized as moderating. Language about considering any adjustment to the target rate, commitment to the 2% inflation target is the same. The decision was unanimous. And finally, there was no mention of the balance sheet in the statement beyond keeping the $95 billion in Treasury and mortgage rate caps each month.
Mike McKee, I'm going to turn to the price action in a moment, but I've got one question I need to ask you right now. Let's go through what you just said again. So faster growth, lower unemployment, higher core inflation, then something jumps off the page. It's exactly the same median dot with some changes around the surface. I know in and around it's more nuanced than that, but ultimately the exact same median dot than December, as December. Mike, can you make sense of that? How have we just revised growth higher, revised unemployment lower, and core inflation up for 24 and left the median dot unchanged?
Well, you have to look at it as the median dot because others did change their views around that dot, but nobody moved significantly higher to push rates up. One person did. They needed 2 to move it up, to move the median rate up. But as I noted, 9 of the 10 now say 2 cuts or less. So it is certainly possible if we see similar inflation and jobs numbers going forward that this could change again. And at the next meeting in June, when they put out a new forecast, they could go to 2.
I guess no wonder people are buying stocks right now. Mike, we'll come back to you in just a moment. On the S&P 500, positive by a third of 1%. Here's the price action for you. Stocks higher. On the NASDAQ, up by 0.4%. In the bond market, a rally at the front end. We're down about 4 basis points to 464 on a US 2-year yield. And the dollar a little bit weaker here. The euro at 108.85. Brad, my first reaction to this, just to see faster growth for 2024, lower unemployment and higher core inflation, and a median dot. And we can get into the changes beneath the surface, I know, but a median dot that's unchanged in the face of all of that. If you're in equities at the moment, that sounds pretty bullish to me, doesn't it?
This is a Federal Reserve that suddenly, under the hood, seems to be accepting higher than expected inflation for a longer period of time, taking longer to get down that neutral rate, because there is no other way to interpret all the numbers that you just laid out. Hotter inflation than expected for the next couple of years, faster growth, and the fact that they're still planning for similar types of cuts highlights where the bias is right now for a Federal Reserve that still does want to cut rates.
If you're just tuning in, joining us around the table, Mohammed El-Arian is alongside us together with Priya Misra, fixed income portfolio manager at JP Morgan Asset Management. Priya, I want to cross over to you. Just your first thoughts on the projections and the statement that we got just moments ago.
I think this is a Fed that really wants that soft landing to continue. They saw a path of that for that soft landing. Now we have had better, better inflation data, higher inflation data than the Fed would have liked. I think the last 2 months, but it's 2 months. You just go back 4 months. We had really weak inflation data in November and December. Jan and Feb came in a little higher. I mean, it was never going to be a straight line down to 2%. I think the Fed is saying we're going to be patient. There's a long time between now and December. Those projections are December projections. That growth getting higher, I wonder if they're telling you the supply side's working, whether it's population growth, whether the supply chain's coming back, that's allowing growth to be strong, that's allowing the labor market to be okay. And the Fed is saying, be patient. We're going to get close to that 2%. It might take a little bit longer. We can start normalizing.
Well, it's fueling a rally in gold. Gold is by
so I'm looking at the sorry, I didn't mean to pause it. So I'm looking at the Fed documents, and I'm going to show you guys in a little bit, but it looks like they're going to hold the benchmark, right? But the forecast is showing a 75 basis point of rate cuts, like I talked about at the beginning of this video, to about 4.6%. They're pretty confident on the slower rate cuts will get there. So the target is still 4.5 to 4.75% by the end of this year. And I do want to pull up the summary of economic projections. But before I do that, let me go ahead and read the statement from the Federal Reserve just real quick. And then if you stay tuned, Jerome Powell is going to give the press conference in about 25 minutes, and we're going to be tuning into that. And I will get to your questions in a little bit. Sorry, I just want to make sure that I go through all of this before I kind of get into the rabbit hole here. And let me see. There we go. Okay, so give me the statement. Okay, so I'm not going to read the whole thing because it is pretty boring. But if you go to the third paragraph, it says, in support of these goals, the committee decided to maintain the target range for the federal funds rate at 5.25 or 5.25 to 5.5%. In considering any adjustments to the target range for the federal funds rates, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. Okay, so no surprises there. They're still trying to achieve that 2% objective, 2% target rate. But what we're seeing right now, and many people kind of were projecting that the rate cuts may not happen 3 times, but maybe twice. The next summary of economic projections won't even come out until June. So as of right now, they're feeling optimistic about where this is going, and this is good news if you're trying to purchase a home in the future. But let me go ahead and pull up the the summary of economic projections. So if you're watching this for the first time, you're gonna get some really, really good kind of lesson if you've never done this before. Okay, because this could be very beneficial for you. Where's my highlighter? There we go. Is that it? Okay, there we go. Can I highlight? Hey, all right. Okay, so summary of economic projections. Make sure you look at the dates here, okay? And make sure it is March 20th, 2024. You don't want to read the previous one, okay? So this comes out every quarter, and they have a meeting, right? They had a meeting March 19th and the 20th, and they talk about the GDP growth, unemployment rate, inflation, PCE inflation, all of that. What I covered at the beginning of this video. Now, I'm going to go ahead and zoom in here. I am blind as a bat. And for my audience, I'm going to start from the top here, okay? So if you look at it here, you see how it says 2024, right? 2025, 2026 in the column. Now, you're like, man, there's a 2.1 and then there's a 1.4. What does that mean? It means 1.4 was what was on the last quarter's summary of economic projections. So last quarter in December 2023, the FOMC said that the GDP projection was going to be 1.4% in 2024. And this is huge. They're projecting that the economy will continue to grow by 2.1% in 2024. That is a 70 basis point increase. That is huge, right? And if you go into 2025, they're projecting 2.0 and then 2.0. I don't really look that far ahead for GDP. But 2024, since we're still at the beginning of the year, I do care about this, right? So if you look at from the previous report, it says 1.4, and now it's 1. It was 1.8, 1.9. So they're feeling like soft landing is coming. The economy will still continue to grow while inflation continues to trend down. Now, unemployment rate 4.0%, pretty much. In line of what the last job growth came out of. So it was 3.8% that came out for last month. And they're predicting that it's going to maintain at 4.0%. In my personal opinion, I think it could tick up as high as 4.2 or maybe 4.3%. I don't think it's going to go even higher than that because the job growth, people are still hiring, right? So from the previous year, it was 4.1, and now they're saying it's going to be about 4.0. And they're thinking that in 2025 and 2026, it's gonna maintain between 4.0 and 4.1%. Okay. Now PCE inflation. So there's CPI and there's core CPI. There's PCE and there's core PCE. PCE is what the Fed pays very close attention to, and this is great. Okay. So they're still maintaining that they're going to get 2.4% going into for 2024. That is pretty much going to meet the Fed's target of 2%. So that's why it makes sense that right now we're looking at 2.8% for PC inflation. It's only a matter of months to get to that 2.4, right? So 2.4% is what they projected in the last summary of economic projections. And in 2025, they're going to 2.2. And then in 2026, they're going to 2.0, okay? So what does that mean? Core PC inflation, that is not counting for energy and food, right? So that's about 2.6, 2.2, and 2.0. So inflation, as we know, generally speaking, not what we talked about earlier about the childcare costs, that is good for the overall economy, okay? Now, going into the Fed funds rate, it's unchanged. So 4.6% for 2024 and 4.6% from the last economic projection, okay? This is big. This is why Wall Street is a little bullish on this, and the S&P 500 is going up right now, is because it was originally 3.6 and now about 3.9. Oh, I'm sorry. Nope, it's 4.6, 4.6. Scratch what I just said. They're bullish because they're maintaining about three rate cuts going into 2024. Now, 2025, originally it was 3.6%. Now they're looking at 3.9%. So it's up by 30 basis points. Now the other one, it's going up by 3.1%. So it looks like the Fed might want to slow down. They're going to want to slow down on the rate cuts going into next year too. So it depends on how the economy is, and it's really hard to predict right now, right? We don't know how it's going to be at the end of this year. We got the election coming up in November, and that's a catalyst for sure for the stock market and for the economy. But longer run is going to be at 2.6% as opposed to 2.5. And that's how it was before the pandemic. It was always 2% or near 0%. That's why we were getting mortgage rates at 4%, 4% to 5% at any given time. So if I were buying a house, I am waiting to this 3.9% here. And I am actively looking for real estate to purchase in the future. And for me, this is going to be something of importance to kind of know where the rates might be at that point. But what I want to make sure is that I want to pay attention to what's going on with inflation. If people go out there and they say they do 3 rate cuts and people are like, oh, it's time to buy a house. Everybody goes out there to buy houses, right? Inflation goes back up again. Let's say it goes from 2.4%, it goes way back up to 2.8. Now the Fed will have to say, hold up, wait a minute. There's a song about that. And they're going to have to say, you know what, hold on one second. We're going to stop the rate cuts for right now. And there's always a chance of let's put another 25 basis points added to the interest rate, okay? They're going to be doing that. They can do that at any given time. And they can do that at every FOMC meeting. So that's why I want to pay attention to, what the Fed might be thinking, what he's going to say at the press conference. And that's going to be very, very important too. So if he sounds like, we're looking at the rate cuts pretty seriously, or anything else that he sounds like pretty dovish, right? And not too hawkish in his tone, then people are going to be like, well, this is going to be going into a great year. By the end of 2024, maybe at the beginning of 2025, I'm going to be looking at buying more real estate. That's what I would do. So, let me go ahead and go scroll down just real quick here. This is what I want to see. So here's the dot plots that everybody on CNBC is talking about. But when I was listening to the news, I actually took a screenshot of this and I want to show you this. Okay. This is so cool because I am awesome. So I want you to ignore this. That's from 2023. What you want to care about is right here at 2024. So this is what CNBC or Bloomberg, what they're talking about. Okay. So from 2024 at right, or if you look back at 2023, you see these numbers right here. I know it's kind of hard to see right now. I can't really zoom in. If you go into a YouTube app, you can actually pinch on your screen and you can zoom in on what I'm talking about here, okay? But it says 5% or 5.0 to 5.5 in percentage, right? So all these dots are the Fed governors. They're the voting members, right? They vote on what the Fed funds rate should be. It's not just Jerome Powell, like many people on TikTok would say. It's actually that many people voting. They're called governors, and they're voting to see, all right, we should stay at 5.25 to 5.5%. Now, if you pay attention to the bottom, that was 2023, right? So this is the new one. On the right side, this is the new one, okay? This is last quarter. For 2024, overall, 2 members are electing to maintain the Fed funds rate at 5.25 to 5.5%. Just no rate cuts, keep it the way it is. 2 of them, okay? And last quarter, there was 1 member say they want to cut the interest rates by 25 basis points, which means 0.25%. But now this one is showing 2 members. So one of them moved up, okay? And now we have 5 members sitting at 4.75 to 5%. So that's unchanged, 5 members. And the majority of members, looks like 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 dots or 9 Fed members are looking to cut interest rates to 4.5 to 4.75%. So the majority of them think that we should cut the rates by 75 basis points, right? That's also subject to change. And there was a low member down here. This 1 dot wanted to cut the rates to 3.75 to 4%. Now it looks like that person most likely moved up to right here. He is more dovish, he or she, I should say. I shouldn't assume the gender. Now it's going to be from 4.25 to 4.5%. So, like I said at the beginning of this live stream, do I see 4.25 to 4.5% happening? Most likely not. It's probably going to be 4.5 to 4.75%, aka they're looking to cut 75 basis points. Looking, not guaranteed. We never use that word guaranteed. Okay, so just keep that in mind. Now, 2025. If you look at the bottom, 2025, 2025, I'm going to ignore the ones on the left, okay? But the new ones, they are looking at the majority of the Fed members are going below 4%. There is that one dude or dudette wants to maintain that same Fed funds rate. That person is very hawkish, okay? And, excuse me, and but the rest of the members, if you look at the dots here, they are looking to go below 4%. So that would be between 3.5 to 4%. Could that go down even further for the next FOMC meeting? Quite possibly, but we don't know. It's a quite possibility that they could go down or they could go back up and say, you know what? Inflation's flaring up again. Let's go back up to 4.5%. Or they could say, you know what? We're good where we are. And American people are hurting on interest rates right now. Let's go back down to 3.5 or even below 3%. Now, if you want to see normal, okay, normal will probably happen here, 2026. Things move very, very slowly. What we don't want to see is a recession. It is much tougher to recover from high unemployment rate than recovering from high inflation. You might not see it that way because you're experiencing it right now. But if you go all the way back to 2008, 2009, if you're as old as I am, or if you remember those years, it was a tough time. It wasn't over in 2008. It wasn't over in 2009. It was not over in 2010 because high unemployment continued to go up, right? It's not at the bottom, but at the top of the high unemployment happened in 2010. And then in 2011, that's when it started to trend down, right? The government spent more money, rate cuts at 0. They were, they were printing money like crazy. So I remember buying my house in 2014, and you're gonna hate me for saying this, but I bought my house for $180,000. at the dirt bottom. And the previous house that I bought was $120,000. You're not going to hear that anymore, right? So tough times, it is tough for the lower income and the middle class, okay? But if you position yourself right going forward, right now, you're going to be in a better place to buy more assets at a discount if we go through a recession or if we go through a stock market crash like we did in 2022. You want to be in a better position, right? 2026 is where we're probably going to see more of a normalized interest rate between 2.5 to 3%, unless something happens between now and 2025. What are some things that we might not be able to predict? That would be geopolitics, things happening in China, with China, Taiwan, right? Russia, Ukraine, the Middle East. They could all be the major catalyst. The election, it is an election year, right? So we'll find out what the yeah. So, but anyway, let me go ahead and pull up Bloomberg just one more time. Let me get my thoughts together. Oops, that's not right. That's right. Okay.
But I think their pandemic practice, was a little bit light. I don't think we have a lot of active central banker data points in terms of how you're supposed to do it. So I think so far, so good. And I think they're trying to hone the message so far here.
You sound very positive on all of this. Does that mean that you're a buyer of bonds of all durations because you think that ultimately they will get to the goal that they're looking for, along with the soft landing that's always been called?
I'm going to answer some questions while we're waiting for Jerome Powell in about 8 minutes. But okay, so can I focus fully on paying towards a home we do not want to move out of and begin 401k contributions after age 35? Not, obviously I can't give you specific financial advice, but just remember this, okay? You can't, the reason why I have that financial independence checklist and say prioritize 401k match and then do Roth IRA, HSA, and then go back to Roth, 401k, the tax advantages that you get with the 401k is far more exponential than anything else that I know, with a Roth IRA as well and HSA. Okay, that's why I always prioritize those investments. House, I get that you want to put all your money into the house, but no one can honestly tell me that that's the home that they're going to stay in for the rest of their lives. Now you said after age 35, so I'm guessing you're younger than 35, and you want to make sure that you are not you're not tying too much money into real estate, right? If I'm buying real estate, I want to make sure that I have enough cash set aside. I want to have a balance between my retirement portfolio and my cash reserve and my real estate, right? I could be cash poor by having too much money tied up in real estate. Why? Because when I buy this house, let's say I buy a house and I put all of my money into it, and I don't have any cash and I don't have any retirement. Now all of my money is tied up in real estate or the house. If I need cash for anything, home improvement, wedding, honeymoon, whatever, birthdays, or trying to travel, what are you going to do? You can't take that money out of the house unless you sell it, you take a loan out, or you get a HELOC out, which I never recommend, right? Interest rates are way too high to get a loan out anyway. So when you do your net worth calculator, and you can go to my website, firesidechat.com/resources, to download my net worth calculator. It's absolutely free, okay? When you download that, it's actually going to tell you what your net worth is between assets and liabilities. And it's also going to tell you how much of your money is allocated to each class. So that's the nice thing about my calculator, is that it actually tells you have 30% of your net worth in real estate, 40% in cash, 30% in, retirement, and you have another 20% in vehicles or something like that. Check it out, but you want to have that balance, right? You never want to be house poor. You never want to be cash poor. You also don't want to have all of your money, same concept, tied up in retirement accounts. Because if you put, let's say you make $100,000 a year and you're like, I want to put all $35,000 into my retirement. Well, you're going to have all of your money tied up in retirement, which you can't touch until at the earliest at age 55, right? Some of the public state employees or police officers, they can take it out at 50 or as soon as they retire. There's provisions to that. But what I'm talking about in general is that you don't want to tie your money up to one asset class, any asset classes. You don't want to have too many vehicles. You don't want to have too much cash. Now you're not having your cash work out for you. So make sure to, take a look at your net worth calculator and you're properly calculating to make sure that you're not putting too much money in anything. But great question. I know some of you guys already answered this in the live chat. I really appreciate that. And paying off the house early is not a bad thing. I want to make it clear on that. Okay. If you choose to get out of the mortgage debt early, that's your choice, because maybe you're someone who's more risk averse. That's okay. You may be in your 30s and you're like, you know what? I don't want to pay on my mortgage at all because, let's say you have some kind of pre-existing medical conditions and you don't want to risk, not having an income or having to pay the mortgage. That's okay. Some people have done it and they're, completely debt free in their 30s. But if you don't have any of that, you want to make sure that you have a balance though, because there is a opportunity cost that you could miss out on by paying off your house early, right? If you're more risk tolerant, put that difference into the stock market or into the 401k, into the taxable brokerage account. I did that. I'm not paying off my house early. That's just me, right? And when I pay off by the time, it was like, I reached that number, but I remember that when I reached the number in my taxable brokerage account, that when I have enough money to pay off my home. That's a good feeling to have. But I'm still not going to pay off my home because that's my stock portfolio is still going to continue to grow and grow and grow. So, okay. Let me see. By the way, Jerome Powell is very on time. Kudos to him. Unlike, some of the government officials, they're very, very late to the press conference, but Jerome Powell is very on time. Let me pull up Wall Street Journal here. I'm going to keep that on just in case he comes up. Make sure it's not muted. There we go. Okay. All right. Hi from Vermont. Awesome. Oh, wow. You might be the first person saying hi from Vermont. Hello from Vegas. It is 76 degrees in Vegas. I'm not trying to brag, but if you're living in, somewhere cold, I'm very sorry. I don't mean to brag, okay? I'm sure you're probably shoveling snow. I used to live in Spokane, Washington, back in the 2000s. And I remember getting up at 5 a.m. and I was like, oh, man, I got to shovel snow in my driveway. And it was like 12 degrees outside. And it really snows in Spokane. Let me know if you're from Spokane or if you've ever been there. Ooh, great question. Yeah, absolutely. Open up a Roth IRA, but you need to make sure that you have an earned income. You can't just put money into the Roth IRA if you don't have an earned income. Okay, that is the number one rule. Number two, if you want to max it out, this year is $7,000. So if you make at least $7,000 in earned income, you can put that towards your Roth IRA. And I'm assuming that you're still living with your parents or something like that. But you're 18 years old asking this question. This is awesome because I wish I had known this. You know what I was doing at 18? I was goofing around. I didn't know jack stuff about, the Roth IRA. No. But the brokerage to use, so full disclosure, I'm not affiliated with any brokers. There's Vanguard, there's Fidelity, there's Schwab. There are other ones too, but those are the three known ones. I have used Chase. They're not bad. Not bad if you're a private client with JP Morgan. But there's a video that I did a while ago about which broker is the best as far as research, index funds, and all that. Check it out. Just type it in fireside chat, best broker, something like that. And it's the thumbnail that has Vanguard, Schwab, Chase, and Fidelity. Okay. My wife has Fidelity Roth IRA, and I have JP Morgan Roth IRA account. I know I used to have Vanguard. I don't know why I switched. Oh, I switched because customer service at the time was pretty terrible, but I'm sure they're better now. But yeah, I'm gonna circle around back to it. Uh-oh, no audio. Weird. That's not me.
The economy has made
There we go.
considerable progress
I
toward
knew it. That wasn't me.
objectives. Inflation has eased substantially, while the labor market has remained strong, and that is very good news. But inflation is still too high. Ongoing progress in bringing it down is not assured, and the path forward is uncertain. We are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustainably strong labor market that benefits all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Our restrictive stance of monetary policy has been putting downward pressure on economic activity and inflation. As the labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.2%. For 2023 as a whole, GDP expanded 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have weighed on business fixed investment. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2% over the next 2 years. Participants generally revised up their growth projections since December, reflecting the strength of incoming data, including data on labor supply. The labor market remains relatively tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 265,000 jobs per month. The unemployment rate has edged up but remains low at 3.9%. Strong job creation has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressure on inflation. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.1% at the end of next year. Inflation has eased notably over the past year, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as from measures from financial markets. The median projection in the SEP for total PCE inflation falls to 2.4% this year, 2.2% next year, and 2% in 2026.
We covered those earlier.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to returning inflation to our 2% objective. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are coming into better balance. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably down toward 2%. Of course, we're committed to both sides of our dual mandate, and an unexpected weakening in the labor market could also warrant a policy response. We will continue to make our decisions meeting by meeting. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of this year, 3.9% at the end of 2025, and 3.1% at the end of 2026.
Wow.
Still above the median longer-term funds rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. Turning to our balance sheet, our securities holdings have declined by nearly $1.5 trillion since the committee began reducing our portfolio. At this meeting, we discussed issues related to slowing the pace of decline in our securities holdings. While we did not make any decisions today on this, the general sense of the committee is that it will be appropriate to slow the pace of runoff fairly soon, consistent with the plans we previously issued. The decision to slow the pace of runoff does not mean that our balance sheet will ultimately shrink by less than it would otherwise, but rather allows us to approach that ultimate level more gradually. In particular, slowing the pace of runoff will help ensure a smooth transition, reducing the possibility that money markets experience stress and thereby facilitating the ongoing decline in our securities holdings, consistent with reaching the appropriate level of ample reserves. We remain committed to bringing inflation back down to our 2% goal and to keeping our longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and price stability over the long term. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Here we go. Q&As from the reporters.
Steve Leisman, CNBC. Mr. Chairman, the projections show somewhat higher core inflation. They also show somewhat stronger growth. What should we infer from this notion that on average, rates were kept the same this year, but inflation is higher and growth is higher? Does it mean more tolerance for higher inflation and less of a willingness to slow the economy to achieve that target?
Well, it doesn't. No, it doesn't mean that. What it means is that we we've seen incoming, as I pointed out in my opening remarks, we did mark up our growth forecast, and so have many other forecasters. So the economy is performing well. And the inflation data came in a little bit higher as a separate matter, and I think that caused people to write up their inflation. But nonetheless, we continue to make good progress on bringing inflation down. And so,
when you just to follow up, when you say that you're willing to either maintain the rate for longer, what is the tolerance of the Federal Reserve for inflation coming in above its 2% target?
we're strongly committed to bringing inflation down to 2% over time. That is our goal, and we will achieve that goal. Markets believe we will achieve that goal, and they should believe that, because that's what will happen over time. But we stress over time, and so I think we're making projections that do show that happening, and we're committed to that outcome, and we will bring it about.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. You and others have been saying that relief on housing inflation is coming, but it still hasn't shown up meaningfully in the CPI or the PCE. Does that challenge your assumption about when the shift will finally break through, since it hasn't at that point?
So I think there's some confidence that the market rents, lower market rent increases that we're seeing will show up in measures of housing services inflation over time. There's a little bit of uncertainty about when that will happen, but there's real confidence that they will show up eventually over time. But again, uncertainty about the exact timing of that. To a new equilibrium where they're going down perhaps not as quickly as they had been earlier this year, where housing services inflation will come back down as current market rents are suggesting will happen, and where non-housing services will move back down. Some combination of those three things, and it may be different from the combination we had before the pandemic, will be achieved and will bring inflation back down to 2% sustainably.
Nick Timmeros of the Wall Street Journal. Chair Powell, during your congressional testimony this month, you said that your test for making the first change to interest rates does not require you to be terribly comfortable that inflation is at 2% because interest rates are well above neutral. At the same time, you said here after the last meeting that the first cut is highly consequential. Can you reconcile these views for me? If rates are well above neutral, why would the first cut be highly consequential? Is that because you anticipate one cut would be followed by one or two more along the lines of the recalibration you made in 2019, which itself was modeled on the mid-cycle adjustment of 1995?
Great question.
I would put it more in the context of what I said in my opening remarks, that the risks are really two-sided here. We're in a situation where, if we ease too much or too soon, we could see inflation come back, and if we ease too late, we could do unnecessary harm to employment and people's working lives. And so we do see the risks as two-sided. So it is consequential. We want to be careful. Unfortunately, with the economy growing, with the labor market strong, and with inflation coming down, we can approach that question carefully and let the data speak on that. That's really what I was thinking.
How much of that inflation that we've seen so far this year do you chalk up to one-off calendar adjustment effects following a period of high inflation versus some change in the trend we saw in the second half of last year?
I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But I would say the January number, which was very high, the January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there. But nonetheless, we don't want to be completely dismissive of it. The February number was high.
I'm going to rewind just a little bit here.
To think that there could be seasonal effects there. The January CPI and PCE numbers were quite high. There's reason to think that there could be seasonal effects there.
You just say check yourself?
In the trend we saw in the second half of last year.
I want to start by saying I always try to be careful about dismissing data that we don't like. So you need to check yourself on that, and I'll do that. But So I would say the January number, which was very
Okay.
CE,
Sorry.
which is not terribly high. So it's not like the January number. But I take the two of them together, and I think they haven't really changed the overall story, which is that of inflation moving down gradually on a sometimes bumpy road toward 2%. I don't think that story has changed. I also don't think that those readings added to anyone's confidence that we're moving closer to that point. But we didn't. Last thing I'll say is we didn't excessively celebrate the good inflation readings we got in the last 7 months of last year. We didn't take too much signal out of that. What you heard us saying was that we needed to see more, that we could, we wanted to be careful about that decision. And we're not going to overreact as well to these 2 months of data, nor are we going to ignore them.
Hi, yes, Chair Powell. Could you speak a little bit more about the timing? Is there enough data between now and, say, May to be able to get the kind of confidence that you say that you still need, or by June? Is there enough data for you? Just give us a sense of your thinking there. Thank you.
Yeah, so we make decisions meeting by meeting, and we didn't make any decisions about future meetings today. Those are going to depend on our ongoing assessment of the incoming data, the evolving outlook, and balance of risk. So I really don't have anything for you on any specific meeting looking forward.
I mean, just the question is there even enough data for you to be able to?
We'll take, things can happen during an intermeeting period if you look back, unexpected things. So I wouldn't want to dismiss anything. So I just would say that the committee wants to see more data that gives us higher confidence that inflation is moving down sustainably toward 2%. I also mentioned, and we don't see this in the data right now, but if there were a significant weakening in the data, particularly in the labor market, that could also be a reason for us to begin the process of reducing rates. Again, there's nothing in the data pointing at that, but those are the things that we'll be looking at.
And that was a stupid question. I mean, what did you expect him to say?
Hi, Chris Rieger, Associated Press. Thank you. In the projections, there is an increase in the neutral rate, as you know, and higher rates, a quarter point higher rates projected in 2025, 2026. Can you speak about why might be behind that? Is there a real sense here that the economy has perhaps changed in some way, that higher rates will be needed in the future? Thank you.
So you're right, they're pretty modest changes, but you're right, there was an uptick in the longer run rate, and also there's a 25 basis point increase in 25 and 26. In terms of are rates going to be higher in the longer run, if that's really your question, I don't think we know that. I think we think that rates were generally low during the pre-pandemic, post-global financial crisis era for reasons that are mostly, important, slow-moving, large things like demographics and productivity and that sort of thing, things that don't move quickly. But I don't think we know. I mean, my instinct would be that rates will not go back down to the very low levels that we saw, where all around the world there were long-run rates that were at or below zero. In some cases, I don't see rates going back down to that level, but I think there's tremendous uncertainty around that.
Great. And just a quick follow on the projections, you also have 2.6% core inflation for the end of this year. It's already or you mentioned it being 2.8 in February. I mean, that doesn't sound like much disinflation at all. So are you still confident? Or last press conference, you sounded pretty optimistic you would get more confidence to the end of this year. Is it right to say that this suggests you're not seeing a lot of disinflation this year compared to what we've seen 2023 and so forth?
I think that higher year-end number reflects the data we've seen so far this year, because you're now in this year. So I think that. Sorry, say your last part of your question again.
Well, just, are you still optimistic that you get the confidence you need this year?
I think if you look at the SEP, what it says is that it is still likely in most people's
Yeah, it's showing that. That's the SCP.
window forward. Nonetheless, we're looking for data that confirm the kind of low readings that we had last year, and give us a higher degree of confidence that what we saw was really inflation moving sustainably down to 2%.
Man, the stock market is really moving. $5,200 S&P 500.
Thank you for taking our questions. Per your comment to Anne that a weakening in the labor market would be a reason to potentially cut rates, or at least a consideration in making a rate cut, would continued strength in the labor market be a reason to hold off on rate cuts? And just in general, if labor supply continued to rebound in 2024 the way it did in 2023, what would stronger hiring and possibly stronger growth mean for the path forward on policy?
Way better questions today than the last one.
So if what we're getting is a lot of supply and a lot of demand, and that supply is actually feeding demand because workers are getting paid and they're spending, and that's, what you would have is potentially kind of what you had last year, which is a bigger economy where inflationary pressures are not increasing. In fact, they were decreasing. So you can have that if you have the continued supply side activity that we had last year with both with supply chains and also with growth in the size of the labor force.
But so strong hiring in and of itself would not be a reason to hold off on rate cuts?
No, not all by itself. No, I mean we saw you saw last year very strong hiring and inflation coming down quickly. We now have a better sense that a big part of that was supply side healing, particularly with growth in the labor force. So in and of itself, strong job growth is not a reason, for us to be concerned about inflation.
Hi, Chair Powell. Neil Irwin with Axios. How do you assess the state of financial conditions right now? And in particular, do you view the kind of easing in financial conditions since the fall as consistent and compatible with what you're trying to achieve on the inflation mandate?
So we think there are many different financial conditions indicators, and you can kind of, see different answers to that question. But ultimately, we do think that financial conditions are weighing on economic activity, and we think you see that in a great place to see it is in the labor market, where you've seen demand cooling off a little bit from the extremely high levels. And there I would point to job openings, quits, surveys, the hiring rate, things like that are really demand. There are also supply side things happening, but I think those are demand side things happening. We saw that's been a question for a while. We did see progress on inflation last year, significant progress, despite financial conditions sometimes being tighter, sometimes looser.
Jerome, sounds good.
Michael McGee with Bloomberg Radio and Television. Can you give us more color on how the committee is thinking about inflation dynamics now? What we've seen at the beginning of the year, are they more one-off increases that will fade, or is there more of a secular turn with goods prices rising again and service prices staying sticky? And also, housing prices have been sort of the Godot of this cycle, in that you keep expecting them to go down and they don't. How does the committee see this playing out forward since you've raised your inflation forecast?
So I see the committees looking at the 2 months of data and asking the same question you're asking and saying, we're just going to have to see what the data show. As I mentioned, you can look at January, which is very high reading, and I think many people did see the possibility of seasonal adjustment problems there. But again, you got to be careful about dismissing the parts of the data that you don't like. So then February wasn't as high, but it was higher. So the question is, what are we going to see? We tend to see a little bit stronger, this is in the data, a little bit stronger inflation in the first half of the year, a little bit less strong later in the year. We're going to let the data show. I don't think we really know whether this is a bump on the road or something more. We'll have to find out. In the meantime, the economy is strong, the labor market is strong, inflation has come way down, and that gives us the ability to approach this question carefully and feel more confident that inflation is moving down sustainably at 2% when we take that step to begin dialing back our restrictive policy.
Well, you've talked about the desire to have confidence that inflation is continually moving down. Has the recent numbers we've gotten for inflation data dented that confidence at all?
It certainly hasn't improved our confidence. It hasn't raised anyone's confidence, but I would say that the story is really essentially the same, and that is of inflation coming down gradually toward 2% on a sometimes bumpy path, as I mentioned. I think that's what you still see. We've got 9 months of 2.5% inflation now. We've had 2 months of kind of bumpy inflation. We were saying that it's going to be a bumpy ride. We consistently said that. Now here are some bumps, and the question is, are they more than bumps? And we can't know that. That's why we are approaching this question carefully. It is very important for everyone that we serve that we do get inflation sustainably down. And I think the historical record, it's every situation is different, but the historical record is that you need to approach that question carefully and try to get it right the first time and not have to come back and raise rates again, perhaps, if you cut inappropriately, prematurely.
No, we talked about that earlier in this live stream too.
Mr. Chairman, Edward Lawrence with Fox Business. I wanted to ask you, you received a letter from, the Federal Reserve, for independent body, understanding Congress has oversight over that. You received a letter from Senators Elizabeth Warren and Sheldon Whitehouse that said, calling on you to lower interest rates, to cut interest rates, because it says, quote, the potential that it may remain too high for too long has halted advances in deploying renewable energy technologies and delayed significant climate and economic benefits from these projects. So has higher interest rates caused that?
Have they? Well, first of all, I respect in our system of government, it is Congress that has oversight responsibility over the Fed. We place a tremendous amount of importance on our engagements with Congress and always treat them with great respect. In this case, I would say those are, our mandate. Our mandate is for maximum employment and price stability and the other things that we do. And that's what we're trying to accomplish. We're trying to do that in a way that sustains the strong growth we're seeing, the strong labor market we're seeing, but allows us to make further progress with inflation. That's how we can best serve the public and leave the other issues, which in many cases are incredibly important, such as those you mentioned, leave those to the people who have responsibility for those.
There's another letter from 24 lawmakers saying that the higher rates are squeezing the working people. How do these letters affect what you guys are doing policy-wise?
We receive these letters with respect, and we write careful responses and address concerns. We listen, again, because we're talking to the people who in our system of government have oversight over our activity. So but at the end of the day, we take that on board, but we have to make our judgments and we have to stick to our knitting, which is maximum employment, price stability, supervise and regulate the banks, work on the payment system, the things that we do.
Yeah. So we talked about this, and I'll get into it later on between the fiscal policy and the monetary policy.
Thanks a lot for the opportunity to ask a question. As chair of the FOMC, would you want to see unanimity on the committee or something close to it, meaning no more than one dissent before you begin cutting rates? Thank you.
We're a very consensus-oriented organization, and we do try to achieve consensus and ideally unanimity. People do dissent. It's something that happens. Life goes on, and it's not a problem.
Yeah, dumb question. I'm going to mute him for a second, but the monetary policy, that's the Fed's job, right? And then there's the fiscal policy, that is the Congress's job, or the White House's job too. Congress they're really frustrated with Powell and the Federal Reserve because they're still keeping the rates high. Now, it's weird because the Democrats really want to cut interest rates right away. Republicans, on the other hand, they want to keep their interest rates high. I'll get back to that.
Some ways away from target. Unemployment, though, if you look at the projection for the full year, 4.0%. In February, we were already at 3.9%, so quite close to the median projection. Are you concerned at all that, notwithstanding the very strong jobs growth, that in fact there may be some cracks appearing in the employment market? You talked about a significant deterioration in the labor market being a condition for easing rates. What would constitute that in your books? Thank you.
So we, of course, monitor it's one of our two goal variables. We all monitor the labor market very, very carefully, and I don't see those cracks today. And we follow all the possible stories that are out there about there being cracks. But the overall picture really is strong labor market. The extreme imbalances that we saw in the early parts of the pandemic recovery have mostly been resolved. You're seeing high job growth. You're seeing big increases in supply. You're seeing strong wage growth, but wage growth is gradually moderating down to more sustainable levels. In many, many respects, things are returning more to their state in 2019, which we can think of as normal for this purpose. That's job openings and quits, and surveys of workers and businesses are always interesting on this. How tight is how easy is it to find a job? How easy it is to find a worker? Those surveys have both come down. So the labor market's in good shape. You do see things like the low hiring rate, and people have made the argument that if layoffs were to increase, that would mean that the net would be fairly quick increases in unemployment. So that's something we're watching, but we're not seeing it. Of course, initial claims are very, very low, and if anything, have tracked down a little bit. So watching it carefully, don't see it. And when I say something, I use the term unexpected weakening in the labor market. So, we do expect the unemployment rate to, the forecast is that it would move up, I think, closer to what we see as the longer run sustainable level. That's just people's forecast, individual forecasts. But we're talking about something that's unexpected. That's where I'll leave it, though.
Steve Matthews with Bloomberg. You mentioned at the beginning of the press conference that the committee felt it might be appropriate to slow the pace of asset runoff fairly soon. I'm wondering, when you say fairly soon, does that mean that the committee would meet about this again in May and a decision could be reached that soon? And I was wondering if you could also just describe the scope of what the committee is discussing here. You're at $95 billion of caps right now. Would that be cut about in half or something in that nature? Thank you.
So that is what we're discussing essentially is and we're not discussing all the many other balance sheet issues. We will discuss those in due course, but what we're really looking at is slowing the pace of runoff. There isn't much runoff among MBS right now, but there is in treasuries, and we're talking about going to a lower pace. I don't want to give you a specific number because we haven't had an agreement or a decision, but that's the idea, and that's what we're looking at. And in terms of the timing, I said fairly soon. I wouldn't want to try to be more specific than that, but you get the idea. The idea is, and this is in our longer run plans, that we may actually be able to get to a lower level because we would avoid the kind of frictions that can happen. Liquidity is not evenly distributed in the system, and there can be times when, in the aggregate, reserves are ample or even abundant, but not in every part. And those parts where they're not ample, there can be stress, and that can cause you to prematurely stop the process to avoid the stress, and then it would be very hard to restart, we think. So something like that happened in 19, perhaps. So that's what we're doing. We're looking at what would be a good time and what would be a good structure. And, fairly soon is words that we use to mean fairly soon.
And will there be a discussion about returning to an all treasuries balance sheet at some point?
So that our longer run goal is to return to a balance sheet that is mostly treasuries. I do expect that once we're through this, we'll come back to the other issues about the composition and the maturity and revisit those issues. But it's, not urgent right now. We want to get this this decision made first.
There's a little bit of delay for the Wall Street Journal. I'm going to switch to Bloomberg here. Just 1 second. Sorry about that. Okay.
Down. We will soon enough, fairly soon, I should say, slow down. Is that
some
we wanna
audio
avoid
problem with
any-
Wall Street
any
Journal?
kind
So
of turbulence. I wasn't thinking particularly about banking sector turbulence.
can you
but,
guys hear this? Okay. Good.
We had some indicators the last time. This is our second time in doing this, and I think we're going to be paying a lot of attention to the things that started to happen and that foreshadowed what eventually happened at the end of that tightening cycle, where we wound up in a short reserve situation, and we don't want to do that again. And I think now we have a better sense of what are the indicators. It wasn't so much in the banking system as it was around, for example, where federal funds is trading relative to the administered rates, and where secured rates are relative to the administered rates. Those sorts of things. We will always be watching the banking system for similar signs, though.
Well, is it also because you're not sure exactly how the reserve supply will react once the overnight reverse repo facility, drops nearer at zero?
I think we broadly think that once the overnight repo stabilizes either at zero or close to zero, that as the balance sheet shrinks, we should expect that reserves will decline pretty close to dollar for dollar with that. That's what we think.
Let's go to Gene.
I think the audio is way better with Bloomberg. I don't know what's going on with Wall Street Journal.
M&I Market News. I wanted to ask also about the balance sheet. Will you said that starting the taper sooner could get you to a smaller balance sheet size. Does that mean you don't have to make a decision on when to end QT at this point? And will you be setting up the process for deciding that sooner, or will you wait until we're close to the end?
So it's sort of ironic that by going slower, you can get farther. But that's the idea. The idea is that with a smoother transition, you'll run much less risk of kind of liquidity problems, which can grow into shocks and which can cause you to stop the process prematurely. So that's where, in terms of how it ends, we're going to be monitoring carefully money market conditions and asking ourselves what they're telling us about reserves. Are they, right now we would characterize them as abundant, and what we're aiming for is ample, and which is a little bit less than abundant, right? So there isn't there's not a dollar amount or a percent of GDP or anything like that where we think we have a really pretty clear understanding of that. We're going to be looking at what these what's happening in money markets, in particular, a bunch of different indicators, including the ones I mentioned, to tell us when we're getting close. Then, though, you reach a point ultimately where you stop allowing the balance sheet to run off, but then from that point, there's another period in which non-reserve liabilities grow organically, like currency, and that also shrinks reserves at a very slow pace. So you have a slower pace of runoff, which we'll have fairly soon. Then you have another time where you effectively hold the balance sheet constant and allow non-reserve liabilities to expand, and then that ultimately brings you ideally in for, brings it into a nice easy landing at a level that is above what we think the lowest possible ample number would be. We're not trying for that. We want to have a cushion, a buffer, because we know that demand for reserves can be very volatile. And we don't want to, again, find ourselves in a situation where there aren't reserves. We have to turn around and, buy assets and put reserves back in the banking system the way we did in 2019-20.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you said you're waiting to become more confident that inflation is getting to your 2% goal before you cut rates. Can you just sum up more specifically what data you're looking at that would give you that confidence?
Sure. So most importantly, we're looking at the incoming inflation data. and the contents of it and what they're telling us. So that'll be, and also the various components. So obviously that's what we want. We want more confidence that inflation is coming down sustainably toward 2%. And I mean, of course, we'll also be looking at all the other things that are happening in the economy. We'll look at the totality of the data, including everything essentially, as we make that assessment. But the most important thing will be the inflation data that's coming in.
But are there things that you would give more weight to, like wages?
Wages is one thing. We don't. Our target is not wages. It's really inflation. We would look to the fact that wages are still coming in very strong, but they've been wage increases. That is to say, wage increases have been quite strong, but they're gradually coming down to levels that are more sustainable over time, and that's what we want. We don't think that the inflation was not originally caused, I don't think, mostly by wages. That wasn't really the story. But we do think that to get inflation back down to 2% sustainably, we'd like to see, continuing gradual movement of wage increases at still high levels, but back down to levels that are more sustainable over time.
Go to Greg.
Thank you. Greg Robb from MarketWatch. Chair Powell, could you say at this meeting whether there were more officials who wanted to be careful and go slower than about rates than were at the last meeting? Was there that sense of maybe it's smart to wait? Thanks.
I guess I'd put it this way. If you look at the incoming inflation data that we've had for January and February, I think very broadly that suggests that we were right to wait until we're more confident. So I think I didn't hear anyone dismissing it as not information that we should look at or anything like that. So I think generally speaking, it does go in the direction of saying yes, it's appropriate for us to be careful as we approach this question.
Brendan.
Thanks, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask you about central bank digital currency stuff. We've been hearing a lot from Republicans in Congress about what the Fed is or isn't doing in a digital dollar. But folks, I know you have said to Congress that you are going to wait for approval before the Fed does anything, launches anything. But folks like House Majority Whip Tom Emmer have said that the Fed is either actively researching or hiring personnel to study the implications of the CBDC. Can you give us any clarity on what the Fed is doing right now on a digital dollar?
Sure. So I think we've been pretty transparent on this, but I'll try harder. So we are not getting ready to, we haven't proposed, we haven't come to a conclusion that we should propose or anything like that. That Congress consider legislation to authorize a digital dollar. And it would take legislation by Congress signed by the president to give us the ability to do what we think of as a CBDC, which is really a retail CBDC with the public of it. So we're just a long, long way from that. What we are doing, and I think what every major central bank is doing, is we're trying to stay in the frontiers of what's going on in digital finance. And it has many, many different areas. It has applications in wholesale finance, in the payment system. And so we to serve the public, these issues have become very front burner in the last 5 or 6 years. We need to be knowledgeable about all that. So we actually do have people trying to understand things that are, but it's wrong to say that we're working on a CBDC and then we've secretly got a lab here where we've got one and we're just going to spring it on Congress at the right moment. We don't. I haven't at all in my own mind made a decision that I think this is something the U.S. should be doing. I just think it's something we need to understand, and we do have people who are keeping up with that as part of the broader payments landscape. That's how I would characterize it.
Mark.
Back.
Thank you. It's Mark Hamrick with Bankrate. Mr. Chairman, April 27th will mark the 13th anniversary since a Fed chairman began holding regular news conferences. How important has that higher transparency been in your view, both for the proper functioning of the central bank and also in accomplishing your mission? And is there more that you and your colleagues can do on the transparency front, and what might that look like?
I generally think, I mean, this movement actually started, 30 years ago, when some academics posited that a more transparent central bank, if the public understands your reaction function, the markets will do your work for you. They'll react to the data. And so it all happens that way. And so there's been a march toward greater and greater transparency. And that certainly Chairman Bernanke advanced that. So Chairman Greenspan did, Chair Yellen did. And so we went from four press conferences a year to 8. So now every meeting really is live now. I think that's a good innovation. I wouldn't want to turn it back. We also have done a bunch of other things. We have an annual supervision report, financial stability report. There's a long list of things that we've done. I think nothing comes to mind as really desperately in need of doing at this moment. We're very transparent. We have no shortage of FOMC participants speaking to the public through the media. And so that channel is full, I would say. So I think it's generally broadly helped and made things better, but not every day and in every way.
Well, to follow up, has there ever been a day where you wanted to put that genie back in the bottle somewhat?
Of course not.
Let's go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Not to harp too much more on confidence and inflation, but you did say earlier in this press conference that the recent inflation data hasn't raised anyone's confidence. But when you testified before the Senate a couple weeks ago, you told lawmakers that you are, quote, not far from receiving the confidence needed on inflation to begin cutting rates. So are you still of that belief or not? What are we to take by those words, not far?
So let me say my main message at that in those 2 days of hearings was really that the committee needs to see more evidence to build our confidence that inflation is moving down sustainably toward our 2% goal. And we don't expect that it will be appropriate to begin to reduce rates until we're more confident that is the case. That is the case. I said that any number of times. So those were kind of the main part of the message. We repeated that today in our statement. I also, to the language you mentioned, I really pointed out that we had made significant progress over the past year. And what we're looking for now is confirmation that that progress will continue. We had a series of inflation readings over the second half of last year that were really much lower. We didn't overreact, as I mentioned, but that's what I had in mind.
But given that you said that PCE for February, 2.8%, the estimate, and that we have been seeing PCE, core PCE coming down by 10% every month, wouldn't you be at about 2.4% this summer, June, July, to a point where you could cut then?
Well, we'll just have to see how the data come in. We would, of course, love to get great inflation data. We got really good inflation data on the second part of last year. Again, we didn't overreact to it. We said we needed to see more, and we said it would be bumpy. And now we have January and February, which I've talked about a couple of times. So, we're looking for more good data, and we would certainly welcome it.
Thank you.
Thank you.
Okay. So, wow, I haven't seen.
You didn't want this to end. Live from.
He was in such a much better mood than he was at the last press conference. So there were many. Most of the questions, some of the questions are always dumb, right? I don't know why they even ask them, but they do. But they had better questions today than they did at the last FOMC meeting. Now, he brought up a couple things. One of the reporters, talking about Elizabeth Warren. She's one of the progressive Democrats, talking about the clean energy thing, right? So I do want to just kind of bring up what she said, and just to clarify a few things. Well, not to clarify for him, I guess. So again, the Federal Reserve job is to enforce that monetary policy, right? Now Congress, their job, that's the fiscal policy for them. Now Congress is going through what's called a election season, right? So we got the election season coming up in November, and people are not voting for the Federal Reserve; they're voting for congressional members, House, Senate, and what do they care about right now? The control of the Senate, the control of the House. So if the Republicans control the House, they control the Senate, and Trump gets elected in November, then this is going to have a whole different dynamic. Like the clean energy that the Warren is talking about, and how this is hurting the future of the clean energy and all that. I'm gonna kind of critique a little bit here, okay? And I've said this, ever since I started this YouTube channel, is that I'm always apolitical. I never talk about who I affiliate with, who I support, any of that. But I do pay attention to the policies and what they write. Okay, I criticize both sides of the parties, and I criticize whoever. I don't lean on one party than the other. Okay, but this one I think is pretty ridiculous, coming from Elizabeth Warren, who is in many committees, and she's been around for many years. She understands how inflation works. So just putting out there and saying that we need to cut rates so that we can continue with the clean energy, that's not the main issue here. We are spending a heck of a lot of money from the federal government. The federal government is spending money. They're overspending money, right? So what she's talking about is the large-scale clean energy projects by the private sector. They can't borrow money at a lower interest rate, and they're holding the projects because of the high interest rates. So the solar projects that they're talking about in these states, Puerto Rico, other territories, the EV battery plant in Kentucky, uncertainty about demand for EVs, that has nothing to do with what the Fed is trying to do. The Fed is trying to calm inflation down, right? People are still spending money like crazy. Is the economy good in general? Not necessarily. It depends on who you ask, right? But I think she is using clean energy as an excuse to say, we need to drop the rates. She hasn't said all of that in the previous congressional hearings, because I listened to all of the congressional hearings, because I am the type of guy who does that, right? Some say I don't have a life doing all of that, but I enjoy listening to that. But what I don't enjoy is they're using what they can to try to justify, oh, we need to lower interest rates so that we can push forward with these projects and all that. Okay, they need to really clean up their budget. The federal government does, not the Federal Reserve. The federal government needs to clean up their budget. They're still spending money. They're racking up, what is it, $100 billion? No, it's about $1 trillion every 3 to 4 months in debt. Every 3 to 4 months, because they're spending more money than they're taking in from the tax revenue. Okay, so that's one step they need to do. Overall, though, this press conference, he was telling jokes, being sarcastic, and he sounded much more optimistic about 2024. And as you can see, that the market is doing really well because they're reacting well to what the Federal Reserve, or to what Jerome Powell is saying. So, going forward, I'm not going to say, hey, today is the meeting that will decide everything that's going to happen in 2024. That's not the case, right? But today was a good meeting. We expected the Federal Reserve to maintain their interest rates where they are at 5.25 to 5.5%. At the next meeting, are they going to change it again? Probably not. I think they're going to keep it the way it is. I do go live every single time CPI comes out, inflation report comes out, right? And I'm going to go in there and see if there's any indications of maybe trending downwards, right? We haven't been seeing that in the last 2 months. It's actually going right back up. So the Fed is like, whoa, okay, let's take a step back a little bit and let's pause and not drop interest rates, because if he did that, like he said in the press conference, that would be very irresponsible of the Federal Reserve to prematurely cut interest rates, and that could lead to flaring up inflation again, right? We don't want that. We don't want high inflation anymore. We care about clean energy, but nobody in the short term cares about clean energy to get, to push the projects forward. We need to bring inflation down so that people are not spending way too much money, and so that they can start saving for retirement. They can start saving for something, for a house. One thing they did mention, speaking of that, is home prices. Home prices are still going up. Why are the home prices still up? Because the inventory is still low, right? I am living in a house that with a 2% mortgage interest rate. Why should I sell my house and move into a house that's going to cost me 6.5% to 7% 30-year mortgage rate, right? It makes no sense if I did that. Now, the home prices should, as he said, start to come down a little bit, but it's going to be very, very hard because one, the inventory is low, right? Like I said, not many people are selling their homes. And number two, it really depends on the area, but Vegas, for example, and I'm in Vegas, there's a large number of people moving into Vegas right now, and there are just not enough homes. So, but if you go to other states, certain areas, the inventory is just flat, right? So the home prices are just kind of flat. So it depends on who you ask. If you're trying to buy your first home, now may still not be the right time to do it. But if you have the money, if you have a large deposit ready to go, if you can maintain less than 25% of your take-home income or gross income, really, then I would say go for it. But you gotta be aware that the rates are still going to be at about 6.5%. So that means you're not going to be able to buy a house that you want it. But if you can't wait for it, you're just going to have to put more money down or wait until the rates come down. Home prices most likely will remain high. Rent, hopefully it comes down, but right now the rent's still remaining at where it is right now. In some areas, they're still going back up. So, but yeah, I thought that was a good press conference, and I'm gonna take a minute here, and I do want to go back to the question that this 18-year-old had. I wanted to finish answering that question real quick. Crap, it's the live chat. Okay, so Sean, you're turning 18 soon, and you're talking about opening up a Roth IRA and maxing it out. You're going to win at life, okay? You are going to do great. So a couple of things that you need to know before you even pick a brokerage. You need to make sure that you have an earned income in the year 2024 in order for you to contribute at least $7,000, which means that you have to earn at least $7,000. If you earn less than $7,000, let's say you only earn $5,000 because you're in school, college, or whatever, $5,000 is the maximum you can contribute to the Roth IRA. Okay. Now, as far as the brokers go, I've had Vanguard. I still have Fidelity. I have Schwab. I have JP Morgan Chase, and there are many brokers that you could use. I want you to go to my YouTube page and look up the best broker for beginners. I did a video on that. Take a look. And I did some deep dive on what broker has what, automatic contribution periods, the research website, how to research for index funds, all that stuff, right? I can't give you specific personalized financial advice, but when you go to that website, I want you to, or go to my YouTube video, I want you to watch it at the same time. Go to those brokers, say Vanguard or Fidelity or Schwab or JP Morgan or whatever, and just take a look and see what is easy for you to use. Okay, which website is the easiest for you to read? That's the ease of use is actually very, very important. And you're 18, you're gonna have that app. Personally, I like Schwab app. It's really easy for me to understand. But when it comes to website research, I like Fidelity, right? Index funds, you may like Vanguard. So you kind of have to pick and choose. But remember this, you don't want to cross between, let's say you have Fidelity Roth IRA, but you end up getting a Vanguard, say Vanguard index fund. They might charge you extra. I don't know, but it would be kind of weird for you to have Fidelity, but investing in Vanguard S&P 500, right? Because Fidelity has one, Schwab has one. So, it's going to be cheaper for you to just keep that index fund within the same broker. And the fees are really low. One downside I do want to bring up is Vanguard has a minimum $3,000 investment amount when you start investing in index fund, if you do the mutual fund. But you can always start with the ETF as well. And there's no minimum for the ETF. So really great question. I wish I asked that question when I was 18. That is so awesome that you're doing this at 18 to open up a Roth IRA and thinking about maxing it out. Man, if I maxed out my Roth IRA when I was 18, I would not be sitting here live streaming to you right now. I would be on the beach sipping on something. Okay. So 401k does something. Does it make sense to only max out the employer? Okay, I'm trying to understand this question. I'm going to read this again. My 401k does not fund that pay dividends in any fund options. Okay, I mean, that's common. Does it make sense to only max out the employer or match and put the rest into individual brokerage and backdoor rollovers versus maxing for? You got like 5 things going on in this question, but I'm going to just kind of dissect it a little bit, okay? If you go to my website, firesidechat.com/resources, there's a financial independence checklist, and it's been the same checklist that I've been using since 2013 or 2014. So it's been 10 years now. So first step, contribute up to the employer match. So that is the bare minimum I'm going to do with the 401k to begin with. I'm always going to contribute. If my employer contributes 100% of my 5% contribution, I'm going to contribute at least 5%. The next step I do is to max out my HSA and then Roth IRA. And then I'm going to come back and contribute more to my 401k based on my income. Okay. Now, whether 401k pays dividends or not, that could be a factor if my goal is to have moderate income in my retirement. But I don't know your age. I don't know your personal financial situation, but you need to kind of like you got to know what your goal is, what your investment objective is going to be. I can't give you personalized financial advice, but what you want to always make sure is to get that employer match. That is 100% return by putting whatever percentage that you have. You get that 100% return, and that's free money into your 401k. Now, remember, whether you put money into Roth or traditional, that employer match will most likely go into traditional unless your employer offers the Roth option. But remember, the employer match, if you choose to put that into the Roth 401k, you'll have to pay taxes on that employer contribution. Okay. Now, individual brokerage and backdoor rollovers, I don't understand that part of the question, but if you make too much money to fund your Roth IRA is what I'm guessing, you can't do the backdoor Roth IRA process. It's very, very simple to do because you have an employer-sponsored retirement plan. Okay, so the money that you put into your traditional IRA when you do that backdoor Roth IRA conversion, it means that you're putting money into the traditional IRA as a non-deductible contribution. Take a look at the traditional IRA rules, and there's a rule about having an employer retirement sponsor plan and making a certain amount of dollars, and having a traditional IRA, and if that's considered non-deductible contribution, 99% of the time you are making, you're over the income limit, right? So the after-tax money you put into the traditional IRA, then you can transfer it to the Roth IRA, and there's no tax consequence for that. Just make sure you do it slow if this is your first time doing it, and truly understand what you're doing, because I don't want you to get penalized by the IRS. But the crucial form that you need is what's called 8606, Form 8606. And that form is going to show the IRS that the money you put into the traditional IRA is a non-deductible contribution, AKA after-tax dollars. It's not pre-tax dollars. And then when you transfer from traditional IRA to Roth IRA, that is after-tax dollars into the Roth dollars. Get a spreadsheet, make sure that you keep track of all of the dollars that you have, because some brokers do a terrible job tracking your dollars or segregating what's what, the sources, the Roth dollars and all that. Just, it's a good way to do it. But if you need help with that, you can go to firestatecheck.com/pricing. There are some plans that you can go through, sign up for a session, and get with me, and we can go over that together. Okay. That depends. For the sake of time, I'm going to just say it depends. But I take a look at a Trinity study if you want, with the 4% withdrawal rate study. But if I flat out say everybody should do 4% withdrawal rate, that is wrong, right? I should not tell people that, and I will never tell people that. My goal was always 4% withdrawal rate. That's mine, right? But it also depends. If I have enough income sources, let's say my YouTube videos still continue to come into my bank account every single month for the rest of my life, because the videos will be posted forever, right? Then if I make, I don't know, say 50 grand a year from YouTube forever, then I don't need to withdraw as much money from my retirement account, say 4%, then it's not really needed, right? I could maybe go down to 3%, maybe 2%. Now, the other thing is, it depends on the size of your portfolio, okay? If your portfolio is massive, let's say you have $3 million in there, I might not need all 4%. I might not need $120,000 a year to pay for whatever. I could probably just live on 3%. So consider your income sources, consider the size of your portfolio, and consider what's going on with your life. Are you trying to, purchase a home, or, buy something, okay? Or what else? There are many considerations to it, but just take a look. 4% is not always the answer, but I personally wouldn't go above 4%. That's just me. If I go 5%, that means that I'm making a huge purchase, say buying a vacation home or something like that. But yeah, that would be the case. But I personally, I'm not going over 4%. Oh, okay. Awesome. You open up a Roth and max the contribution for last year, but I also have a TSP, that is Thrift Savings Plan, if you don't know what that is, which is the federal government version of the 401k. I've been contributing to the Roth TSP. I was wondering if I should put more to my TSP or open up a taxable account. So again, if you follow my financial independence checklist, start with the TSP, assuming that I'm guessing you're a federal employee. I don't know your financial situation. You may be, if you're a member of the military or the armed forces, and if you're under the legacy retirement plan, okay, then you're not going to get the 5% employer match for the TSP. But if you're under the blended retirement system with the military, then you're going to get that 5% employer match. But I'm going to assume that you are a federal government employee, then you get that 5% employer match for federal employee retirement system for first, okay? So always contribute at least 5%, because that's 100% of the income that comes in to pay for your retirement, because 5% of your income will come in automatically if you do 5% minimum, all right? Now, the next step I put in the checklist is HSA. So I talked plenty about HSA in the past. Max out the HSA and then max out the Roth IRA, and then come back and do more TSP. I don't know your situation. Are you making, like, let's say you're GS13 or GS15, making $200,000 a year, or let's say you're making $150,000 a year as a GS13, GS14, then you're going to have more room to possibly max out the TSP. It's not easy. Most people can't max out the TSP, right? So, but if you're making, I would say, at least $120,000 a year, try maxing out the TSP. But you always want to make sure that you're not putting too much money into the retirement. If your income, if you could save up to 25%, of your money towards retirement, you're going to be winning. Okay. So if you make $125,000 a year as a Fed employee, 25% of that would be 31,250. I don't know how old you are, but if you put 23,000 into the TSP, and then you put another 7,000 into say Roth IRA, and then you can put more into HSA, you're going to be at that 25%, right? If you want to exceed it because you're a late starter, you can, but you just have to kind of calculate your retirement numbers as you go. You know what? I'm going to show you my TSP calculator just real quick. Don't want to go too much in depth about that, but it could be very, very helpful for you to figure out your number, and you can do this on your own. Okay, but and you can get this from firesightcheck.com/resources, and there we go. Okay, so go to firesightcheck.com/resources, and then you get the retirement calculator. So let's say, I don't know your income, I don't know how much you make, but you do, and I don't know how old you are, but let's say you're 30. Okay, in 2024, you're making $100,000 a year, 15% for the TSP, and you get a 5% employer contribution rate. And let's say your income increases by 2% every year. I don't know, you can put your current retirement balance in there. I don't know how much money you have invested, but just put that money in there. For the year-to-date portfolio return, right now, let's take a look here. If you go to the membership board, you're gonna see the C fund. Oh man, look at the C fund. It's already making 9%. Do you see this? 8.92% return already for the C fund. And S fund is returning 3%, and I fund. Wow, I fund is doing better than the S fund at 4.8%. F fund is garbage. Looks like it's down at negative 1.46%, and G fund is at 0.91%, not even 1%. So C fund is doing really, really well right now. But you can go to that website, go to my website, firesightcheck.com/resources, go to level 1 membership dashboard, and you're going to see the TSP performances. So let's say you do 9% this year, right? And in the future portfolio return, you can put 8% on there, right? So if you just contribute 15%, just 15% of your income towards your TSP at the age of 30, because you didn't put your age in there, and by the time you're 48, you would have about $1 million in there, all right? And you would, by the time you're 55, you would have about 2 million, and by the time you're 60, 3.2 million. I mean, you could quit your job and leave your money in the TSP, and it's still going to continue to grow. That is the nice thing about it. So use this calculator, figure out how much money you can contribute to the TSP. If you're a high income earner, try to max out the TSP. If you can't max out the TSP because you have some debts, I recommend you clean that up. But if you go to my website using that FIRE checklist, hold on. Yep, there we go. The FIRE checklist. Clean up your debt if you can, okay? Emergency fund up to deductibles, retirement plan up to employer match, pay off your debt, accept mortgage, max out your emergency fund, Roth IRA, HSA, employee retirement. You're not gonna get to step 7 until you finish all first 6 steps, okay? Maxing out your TSP is actually difficult to many people. So just pay attention to what you're contributing so you're not going to be too cash poor going forward. But really great question, and wish you the best of luck with your TSP. Yeah, 18 was wild for me. Awesome. Wow. Okay, so this is the question I answered earlier with the you're 18, joining the U.S. Navy. Well, I can't give you personalized financial advice. I know you're asking about CS and I funds. I mean, there's no, if you don't know what you're doing at the beginning, you can't go wrong with the target date retirement funds. It allocates that money for you. What I want you to do, because you're 18, I want you to just kind of get to know what a C fund is, what an S fund is, what an I fund is. Look at their historical performances, what they're investing in, and how they can grow your portfolio, right? Past performances, you'll always hear that. They don't guarantee your future results, right? But it is a good, you don't want to invest in something that you don't understand. As soon as you join the Navy, what the TSP is going to do, they're going to automatically put you into a target date retirement fund. So you're 18 right now. Oh my gosh, you're going to be, wait, when do you turn 60? 2066. So you're going to be in the target date retirement fund, life cycle fund 2065, because that's around the time you turn 60. Excuse me. So as you put money in there, they should automatically put 5% of your income, unless they change that, I don't know, into the TSP. And then they're going to put another 5% or 4% from the Department of the Navy. And then 1% would be the automatic contribution from the agency. It's called an agency match. Okay. So if you put 5%, you're going to get 5% back. Just put money in there. When you're ready to increase your contribution, go ahead and do that. What you want to avoid, okay, this is coming from someone who's an Air Force veteran. Don't get a car loan. Don't rack up your credit card debt. Don't try to show off to your peers by buying a cool car. Trust me, nobody would care but you. Buy the cheapest car possible, because when you do that, when you buy a car with $600, $700, $800 in car payment that takes up half of your paycheck, you're going to delay a lot of things. And trust me, from a 38-year-old, do not get a brand new car. Get the cheapest car possible. And I remember living in the dorms or barracks to your Army and Marines. That's my regret, is that buying a vehicle that I thought I would just show people off with a pickup truck. And turns out, making those car payments just wasn't worth it. Keep your budget in line. I have a lot of many of my clients who are active duty, and they're doing really well because they're managing their money and they're not spending money like crazy, and they are doing something incredible, no matter what branch. Okay, you're gonna do great things. As soon as you finish boot camp, you're going to be focusing on your technical training, get great at your job, look after your brothers and sisters next to you, because you're going to need to rely on them as they're going to rely on you. I spent my time in Iraq. I spent my time in Afghanistan. I went to Kuwait. And I remember that, nothing else matters as long as you got your friends, your bros and sisters right next to you. Okay. Look out for each other. And when you finish that boot camp, hit me up and I will make sure that we take care of you. We care about the active duty people, because I was active duty too. And, they're the military, and you will learn this, and you guys can chime in on this. The military will not teach you about TSP. They will not. No matter what they say, they will not. You have to learn it yourself. Unfortunately, that's just the way it is. When you start investing, take a look. When you get that PIN number in the mail from TSP, log into your TSP for the first time. You've already accomplished step one. Step two is to truly understand what CS and I funds do. Okay, how they're invested and what their returns are. Now, manage your money right. And then you can increase it to 15%, 20%, 25%. Okay. Just make sure that you manage your money correctly. You're going to see your comrades, your brothers and sisters buying brand new vehicles, taking out loans for this and that, racking up credit card debt. They all regret it. 10, 15 years from now, they're all going to regret it. So please don't do that. And I wish you the best of luck at the whenever you go to the boot camp. So backdoor conversion has nothing to do with the TSP, Molly. Backdoor conversion is for the Roth IRA. So it's just a Roth IRA backdoor if you're over the income limit. Okay. So if you're just doing the TSP, Roth, or traditional, I can't answer that question if you did, if you did the right thing or not, but the backdoor conversion is about the Roth IRA, traditional IRA and Roth IRA, which is the individual retirement account. It has nothing to do with the TSP. You just need to kind of look at your overall income and see how much money you're putting into the Roth and traditional. And you should calculate how much you're going to make from your, I don't know if you're a federal employee, I'm guessing you are, how much money you'll make from federal employee pension, right? And how much money you're going to have in your TSP. Are you, besides Roth and traditional, the most important thing is the savings rate. If you can max out your savings, you're going to do great. Promise. Savings rate trumps market return. Remember that. The market will do its own thing. That's nothing you can do about it. Your savings rate, you have a complete control over that, right? Yeah, awesome. And just go to that TSP calculator that I have on my website, firesidechat.com/resources, and just plug in the numbers and see where you are. And if you still need help with that, you want to go a little bit further and join my private client program, go to firesidechat.com/coaching and just sign up for the first free session if you haven't done that already. If you have done that, then you can do the individual sessions or you can do the long-term session. It's all on that website. Well, I do care about the expense ratio. Congrats for having 400K in your traditional 401k. First of all, that's fantastic, right? 401k in general is very expensive. I know I've been talking about TSP in the past, but TSP is the same as 401k, but it's cheaper because it's they don't have like the 401k managers doing all the trades in the background or managing mutual funds. They're all index funds. That's why TSP is so cheap. But 401k, I'm guessing you're talking about the mutual fund that has a higher expense ratio at 0.6%. So take a look at what you're investing in. And, what matters more is how your portfolio is diversified, right? Are you investing in something that's very aggressive that doesn't meet your risk tolerance? Or are you fairly balanced as opposed, when you look at your goals, right? You want to make sure you're diverse, your portfolio is diversified so that you can meet your goals and it's not too risky or if it's not too risk averse. Either one. I don't know your situation, but 0.6 to me, it just kind of depends on what I'm trying to achieve. So should I be worried? I would be worried if I don't know what that is, what I'm investing in. So if you're investing in 0.6% or paying 0.6% annually, but the fund is making 10% return every year, your net return is still 9.4, right? The 401k plan should tell you what the net return is and also the inflation adjusted return it should be under unrealized gains or one of the reports that it generates. But if you need help with that, just go to firesidechat.com/coaching and you can sign up for the first free session if you want to. But if you already did that, you can take a look at the other plans for an hour, or you can do the long-term plan too. But congrats for having $400,000 in your 401k. That is tremendous. I mean, they have pros and cons, right? So there's why not both? I mean, I wouldn't say there's real estate is better than stocks and stocks are better than real estate. But the nice thing about the like certain brokerage accounts, like UTMA allows parents to have real estate in that brokerage account, believe it or not. But take a look at it. It's called Uniforms Transfers to Minors Act. And then there's the UGMA, but that doesn't allow the real estate assets in there. The one thing that I do pay attention to is the step up cost basis. I can't speak to real estate on that. I have to talk to one of my friends in real estate about the step up cost basis. Nah, I'm not going to answer that because I don't know for sure, because it might bite me in the butt later on. But I know that when you transfer assets down to your kids or your beneficiaries, remember that there's a step up cost basis. Means that if I had $300,000, or round it up, let's say I have $500,000 in this portfolio, and the cost basis was $200,000, and my earnings and interest were $300,000. The day I die and the portfolio is worth $500,000, now the cost basis will become $500,000 as well. So the beneficiary who receives, say my daughter receives my brokerage account with the $500,000, now she doesn't need to pay taxes on the earnings and interest because now the cost basis, step up cost basis, right? Going from $200,000 to $500,000. So that's the nice thing about it. I can speak more to that, and I have done videos on the step up cost basis. You can type it in on my channel and take a look at it. It is a very broad question. It just kind of really depends on how your real estate properties are structured too. Like, I don't know if you have partnership to own that real estate. Maybe you have, commercial real estate. That's a different subject too. But good question though. I'm hungry. Sorry. I've been live streaming for a while, 2.5 hours, and I have client meeting. So I really appreciate you guys being here. And I know there were more questions to go through. I'm going to put timestamps in this. I know some of you guys have been sticking around to watch the Federal Reserve. Really awesome for you guys to be sticking around with me for this long. But next time I will be going live stream in about 2 weeks, and bring your questions when we get there. All right. But I will put timestamps on there. So, you can navigate this if you're watching this on replay. And this has been another beast of a video, and I hope you got a lot out of it.